Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. This week, I'm eating a little crow on my expectations of this week's options optics. The guppy tries to swallow the whale. Crypto surged to all-time highs, and I want to share with you some insights with price pattern recognition. Cannabis stocks light up, and we'll revisit Tilray and see what lessons we can learn and where I see it going in the immediate future. All that plus your questions, and to help me out with today's show is my co-host, Mr. X, Twitter Tom. Hello, Thomas.
Hello, John. How are you?
I am surviving a wild week. A little bit less my expectations for this week. So for me, it was a little, even though it was quiet, for me, I felt like the market did not do as I planned.
Yeah, it's quiet. It's the same theme, John. We've talked about this for the last few weeks. It feels quiet. Although, nevertheless, we've got some interesting stories, some interesting angles to discuss. So I think it's going to be a good show. I think it's going to be valuable for our users. And it's going to be jam-packed. But before we jump in, John, just a quick reminder for those of you watching directly on our website. If you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. And for all of you watching on our different social media channels, just go ahead and ask those questions either directly in the chat or leave a comment, and John and I will get to as many as possible. All right, John. So once again, the market continues to march higher. John, I cannot remember the last time I said something different. It feels like we're just sort of, marching to the same beat every week. We've talked about different data points, right, over the last month, 2 months that continue to suggest the market could be running on fumes. Maybe these fumes could be extinguished, but not yet, John. The fumes continue to be there, to be visible. And even last week, John, you sort of had an idea on maybe the direction of the market based on options activity, which didn't quite work out, right?
Yeah, I mean, I totally got it wrong. I thought with the large put to call ratio that we were going into this week's expiration that we would see some kind of a correction, or at least the market moving towards some of those higher open interest strikes. But I'll tell you what, one way to make 4 million puts worthless is to settle the market at all-time highs, right?
That'll do it, John. That will absolutely do it. But listen, as a trader, right, as traders, as investors, all you can do is play the probabilities, right? You continue to look at the evidence, at the data points, and you work with what you've got. And although the market hasn't fallen yet, John, the data continues to mount. The evidence continues to build. Now, I saw an interesting research note from UBS this week, John, which made a comment on the weighting of the Mag 7 in the S&P 500, and it breached 34% for the third time. And there's been examples in the past, John, from 2021, 2022, and over the last year, when the Mag 7 exceeded 27.5% and 34% respectively. The index had a short rally, but then it rolled over by about 13% over the next 2 months, John. And that's a number, that 13%, that would fall into the correction category. I think it's a realistic, perhaps, expectation of what could happen, John. What do you think about what UBS here is saying about the Mag 7 weighting?
Well, I kind of want to reiterate what you've been saying, and what we've been saying for weeks, right? I don't want to be a Debbie Downer. I mean, obviously we all want to be bullish of the market, but I kind of feel like I'm standing in the eye of a hurricane, and I'm looking up to sky blue, but all around me, I see all this swirling evidence that something bad is going to come. And so this data point to me is just another one that I talked to you about earlier in the week in our production meeting, was that the equity risk premium, the expected return of equities to the risk-free rate, in this case, let's say the 10-year note, is at zero. And that has also preceded major corrections in the market. So it's just another piece of information that is not signaling that the market is going to go higher. So, yeah, I think, you look at all this evidence that's kind of building up, and then we look at, let's say, where the market is in terms of all-time highs. But there's something else that I've been interested in, and I think we got this question last week was about, how do you use the VIX, right? And so, one of the things what we can do to look at the VIX is kind of gives us a sentiment of what investors are thinking. And the VIX here is getting to, some historically low levels. It's below 15. And so below 15 is kind of really telling me that, the market is screaming to me that it's probably prudent at this juncture to do some type of hedging, right? Because it's very cost effective. Puts are cheap, right? So, we got a low VIX. We're perched at all-time highs, and we see all this confluence of evidence that, things are overheated or that we're running on fumes. So it just seems like, I'm thinking about looking for opportunities to hedge. Now, one of the hedges that I looked at this morning was doing in the S&P, the SPY was doing a 660 call, sell the call, and buy the 620 put. Now, you could have done that today at one point where it didn't cost you any money. So in other words, I'm putting on a hedge for free. My only risk is that between now and it was the September expiration, that the S&P goes above 660 or 6,600 in the index. I don't think that's going to happen, especially with all the uncertainty that is going to drive the market over the next 3 to 4 weeks. So that's kind of what I'm thinking about, Thomas, that the market is telling me that there could be a correction. And then if there is a correction, I want to be positioned, with some protective insurance.
John, as we continue to talk about, the evidence mounting, I'm reminded of one of my favorite quotes of all time, which is, the market can remain irrational longer than you can remain solvent. That one just keeps popping into my head right now, John.
I thought the same thing this morning. I was like, you don't want to hedge all the time, right? Because that really kind of diminishes from your portfolio's returns, right? If you're continuing to hedge. But there are moments in time, and I think this is one of those moments in times where it's worth the risk to hedge, especially if I can hedge at a cost-free, right?
Exactly. John, there's a question you've asked me multiple times in the past, and it's, am I buying here? Am I buying the all-time high? And my answer continues to remain no. I've been, perhaps fortunate, John, if you want to say that, to have built a position at much lower levels, and I'm just sort of enjoying the ride, not worrying about whether I should continue to add exposure here. But John, the question is not necessarily, are we going to buy here at all-time highs, but what do you need to see? What sort of correction or sell-off do you need to see in order for you to buy this sort of broad market index?
Well, I kind of like your number around 13%, but let's look at the chart here. We're still in this channel, right? So as long as we stay in this channel, all things being equal. Now, I think if we break the channel, then I think the market will fall down to this 6,200 level. I think this is more of a psychological number right now, but it also lines up with those 4-week lows, which we said is usually a level where you'll see some hedging come in. But to me, I think I would like to see the market pull back to this gap. And this gap was the gap that started this whole rally where we had broken out from a previous all-time high. And I love gaps. And we're going to talk about gaps a little bit more today. I think gaps are a really powerful trading tool. So I wouldn't be surprised if the market, if we broke the channel and broke 6,200, that would fall back into this gap. Now, that gap is between 6,028 and 6,059. So that would be where I would like to be a buyer. Now, if I just do the math real quickly, that's about 400 points from where we are now. So that would be about what, 8.5%? And that would be a minor correction, right?
Yeah, absolutely. Well, I've got cash, John, that has not yet been put to work in my bar chart 401k. So I am sort of waiting for this correction or sell off, whatever you want to call it, so that I can deploy this capital. So selfishly, John, I would like that to happen at some point, sooner rather than later.
Yeah, I think you got to wait. I think it's September. I think you're going to get the numbers at the end of August. You get the PCE. Is the Fed going to raise rates lower rates? And if if they lower rates, is that a good thing or a bad thing? So I think there's a lot of data that's still to come, and something along the line could trip the market up. So we'll see what happens.
All right, so let's jump into a stock, John, that it's had its ups and downs this year, but lately it's been a driver for sure of the index, and that of course is Google. Now, I think I own it, John. I think you own it. We've sort of expressed our belief that Google's in a good spot, just because it's a solid company, but also because the potential for a breakup. And we've said that the value of the breakup could far surpass the current market valuation.
Yeah, we got the judge's verdict is going to come up sometime in the next week or by the end of the month. At what we're hearing, and then I think a lot of folks are feeling the same way as you and I feeling that Google is worth more of the sum of the parts than the whole if the verdict comes back that they need to break up. And I think that's kind of what this run up has been up. And so recently. I played that trade. I played that by the rumor kind of story. And I added to my position around the 180 point. And then when we got near 200 last time, I sold $200 calls against it and collected a nice little premium. And then the market back up. And now today you can see, well, we're above that strike, which would have been an expiration for me today. So I had to ask myself the question is, do I roll off this trade, right? Again, what I had set up, or do I buy back the calls? And so I decided today as I rolled off the trade, because in essence, this trade, I made about 12.5% return in the 30 days. And I still believe that the breakup is, it's not coming yet, right? And I think you both and I agree when we talk about breakups, we look at most recent market history, the value comes after the breakup, right?
Yeah, absolutely, John. And the one that just keeps popping into my mind, and I'm sure a lot of our viewers are going to be familiar with it, is GE, right? GE has had multiple spinoffs, multiple IPOs, and it just seems, John, like they've all done really, really well. And, as good as GE has done, I look at Google as being a much more valuable company than GE with properties that are highly desirable. And I think that success that GE has seen could be replicated here in Google.
Right. And again, think about, this froth that we're talking about in the market. What was one of the news stories that popped up this week about Google?
Well, that's a great question, John. And this is kind of a big reason why we're talking about Google this week is the relationship or potential relationship with Perplexity. Now, I'm sure a lot of you have heard of Perplexity. Maybe some of you haven't. If you haven't, think of a Chat GPT, right? In fact, for those of you following on X, you probably see a lot of people responding to posts saying @Ask Perplexity, because Perplexity just responds with its own thoughts. But John, here's the deal. Perplexity is now valued at $20 billion. And in January of 2024, less than 2 years ago, it was only worth $520 million. Huge increase, John. But here's the relationship with Google. They have expressed an interest in acquiring Google's Chrome browser for $36 billion, almost twice Perplexity's recent value, John. It's like the fish trying to go up against the giant, right?
Yeah.
So my goodness, what does this story tell you, John?
Well, I think this is just adds more fuel to the fire of what we talked about. Is I think you and both and I agree that Chrome is worth more than $34 billion. It's probably worth more like $100 billion. But I think this also adds to that narrative that we just talked about, that looking at the current market conditions, and to me, this is very similar to something that we saw during the .com. We get overvaluations and, these crazy evaluations, of mergers and acquisitions. So I think it's both. It's telling us that Google is worth more than what probably the current price is, but it also is giving us that kind of that warning that maybe, that we might be near a speculative top. How do you feel about that?
Yeah, I don't see it as quite the .com bubble insanity. I've been aware of Perplexity for a long time. I think they're a really up and coming company. I'm not surprised at the valuation. AI and the mania that AI is sort of invoking right now. But I think we're perhaps on that trajectory, right, where we eventually get to the mania that the dot-com bubble saw. Whether it's next year or the year after, I don't know. We could be on that path. I don't think we're quite there yet.
Okay.
All right.
Let's talk about some other manias, though. Right?
Let's talk about some other manias. And again, for those of you who are longtime viewers, John is a huge crypto proponent. He keeps asking me to do these segments, so I'm just kind of going with the flow here.
I beg him every week. I say, "Come on, Thomas, we got to do more crypto."
All right, so Ethereum, John. Let's start with that. We've talked about this, I think, the last two shows. So the first show, John, maybe 3 or 4 weeks ago, we noticed that Ethereum was coming up to resistance at 4,000. My belief, John, was that it had already knocked on that door 3 times, and at the fourth knock, it was going to break through, and it did. And then last week, we got a question, John, about Ethereum. I think it was about 4,400 at the time. Ethereum ended up shooting up to about 4,780, John. So it got right up to that all-time high. Not quite there yet, but on the horizon. It's pulled back a little bit, John. Here's my thoughts on Ethereum. Now, I've long said that there's this thing called the 4-year cycle, and that crypto would likely peak towards the end of the year. I think we're on track for that. But there's 2 paths here. The first path is that Ethereum just keeps going higher, breaks through its all-time high, gets above 5,000, maybe gets to 6,000 in relatively short order. I don't want to see that happen, John, because if that happens too quickly, I think the top is going to come a lot sooner than I want and what other people want. My preferred path number 2, is for Ethereum to get a cool-off period. And not just Ethereum, just all of crypto, John, all these altcoins and Bitcoin, just a collective cool-off period, maybe 2 months, John. Just pump the brakes a little bit, let the dust settle, and then get that sort of late Q4 move higher, John. And that's when you could potentially see an Ethereum get above 6,000, maybe even sniffing 7,000. But in order to see those high prices, John, I think we need a sort of a 2-month cool-off period here. Is that how you see it?
Well, I mean, again, I don't have a dog in this fight, but just some points of reference here is the 48.65 is the all-time high, and we had a secondary high that was made in December of 21, which was this 47.71, which Thomas told you we just broke a little bit above that, and now kind of we're retreating off of it. So that's very common for a market to, when it breaks out of an old resistance level or an old all-time high and then run to the next level of resistance and then pause or pull back in. So I like your theory. I like that idea. Again, where would I be looking at a buy? I like to look for these explosive candles where the market doesn't spend a lot of time. Notice there's an explosive candle here, but there was a lot of activity that was in this range. So I wouldn't be surprised if we did come back here. This area might fail as in terms of a demand zone. I do like these 2 explosive candles, and so I got a little bit of a range right here, 39.83, 38.95. And again, this is a different time frame. This is a 2-hour time frame. Let's go to a daily, and we look at that demand zone is inside of this green candle that broke out from the most recent high. So if that's your theory, looking for that consolidation pullback, there's, I think, your target to give you that strength. The market holds there and move higher. But when you were talking about crypto is, also Bitcoin made an all-time high this week, right? So what's your feeling about that? And then I want to show folks a really cool chart pattern as I pull it up that I think can be applied to all markets, and I just kind of want folks to learn about that.
Yeah, I mean, very quickly, John, Bitcoin is the driver of the market. Ethereum has greatly outperformed Bitcoin of late, but Bitcoin is still the king, the undisputed king of crypto. And as Bitcoin goes, I think so goes the crypto market, John. So you notice an interesting pattern, which could sort of, perhaps provide direction over the next couple of months. What did you see?
Yeah. So when we look at candlesticks, there's a reason why I like to trade candlesticks, because of these wicks or shadows, what they're called. they kind of help us tell a story sometimes, and especially if they're long wicks or long shadows. And the story is that a lot of times is when the market is moving up and you create one of these wicks, that the wick is actually pointing to an area of large orders, large institutional orders. And what happens is the market is moving in a path of least resistance, right? In this case, it's rallying up. But at some point, it recognizes this group of large orders, and the algorithms recognize it. And then what happens is they push the price back down. So that can identify a level of resistance or a level of supply, some folks would call. So that's what we're seeing here. Now, what was really interesting to me was that we returned to that level this week. And, we made, which looks like to me one of my favorite chart patterns, which is called the tweezers or twins. And that's where the green candle closes and the red candle opens at relatively the same area. Now, twins, where with the candles would be exactly the same. But a tweezer top could also take the formation of an engulfing candle, as you can see here. But the point being is that this price pattern is recognizing, right, the imbalance between buyers and sellers, that there is a large amount of selling up here. And so I love this pattern, and I made a living trading off of this pattern because it's a real easy pattern to trade risk and reward wise. Basically, all you have to do is you have to wait for the red candle to break the low of the previous candle, and then you can take a short anywhere inside of this range, and you just use the top of the two twin candles as your stop. Now, what else is nice about this one is you get really fast instant gratification, usually within the second or third candle, and you can get some nice risk reward ratios. Now, I just want to show you something, Thomas, here is I'm just going to go back a little bit in time here in the market, and I'm just going to point out, there is the same pattern right there, right? Now, it's near an area of resistance, but notice the quick gratification. But here's the point. Once you get the fall away, and then when price returns to that, usually you'll get a pause. Not necessarily you'll get a second drop off, but you'll get a pause. And notice that if we look at these twin tops, you got a pause on that candle. Now look again, here's the same pattern, right? And then notice that just close to it, just barely there, and then it broke out. And again, here's twins here, right? We got a little test right there, which created another set of twins. We got another test, right? And then again, look here, we got a pause here and the second test after the fall away. So I think this is kind of a cool pattern. I think folks should start watching for this pattern, no matter what markets you trade on. But in this case, if the tea leaves are right on this one, then we should see Bitcoin pull back. Now, where will it pull back? Well, I drew this line here around 11,900, 12,000. I think that would be a relatively reasonable level for it to fall to. But you think about it, in this trade, you probably only had to spend, a very small amount of risk to get that potential target.
Good stuff, John. I like that analysis. I like that it coincides with my preferred path. So hopefully, fingers crossed that is the outcome.
Well, I just want to show you one more thing before we go away. Notice our wick here was outside of our Bollinger Bands, and we've talked many times about Bollinger Bands, about mean reversions. So, again, a reconfirmation of, the things that we were kind of just talking about. Okay.
All right. So, John, a few shows ago, we talked about Open Door and the fact that Open Door had exploded. And we did something revolutionary, John, which is we asked ChatGPT what would be the next meme stock. And it highlighted Tilray Brands, a cannabis stock, John. And that also coincided with your analysis because you were trying to use bar charts, tools, and data to find the next potential meme stock. And the two worlds combined for the same answer. And you just love when stuff like that happens, John. Fireworks in the sky. John, you're the man of the minute. Tell us about Tilray and how you are a genius.
No, I don't think I'm genius. I think it's just blind squirrel finds a nut once in a while. And we got lucky that this week that the Trump administration said that they were going to declassify, or that are looking to declassify cannabis stocks for lowering that. And so that's the catalyst that I've been looking for in this particular sector in space. But we were looking at it for the reasons why. We said about some examples, or we needed large volume, we needed a downtrodden, we have a comeback story, a lot of other things that made this a potential meme stock. But we got the bounce and we got the jump, and look at the volume here, Thomas. We went from trading like 20 million shares a day to over 200 million. So I mean, that is a huge confirmation of what we saw, and it's not surprising that the market is now backed off as volume has fallen down. A little bit of the buy the rumor, maybe some of the sell the news. I'm going to talk about where I see this is going to go, but I love teaching about price patterns and some things that we can trade off. And that I love gaps. I talk about gaps all the time. So in this particular trade, I wanted to look for a target. And so I thought a very obvious target for me would be this gap. Now, gaps are powerful because they when we look in the equation of price in this battle between buyers and sellers, when one side of that equation is zero, meaning no buyers or no sellers, a gap occurs. And that is just the mechanics of price. And so that when price returns to that is, again, a level where we might find some unfilled orders. In other words, there's probably going to be some selling here. So I put in some orders to take advantage of this rally. And on a position that I added a little bit more to my position when we broke out above 80 cents. So I was looking for, profit taking out. And so I'll put it right here at the 137 level, which is what would fill that gap. Now, here's the experience. I know not to do that. I know that when I'm looking for an exit trade in one of these gaps, I should be, a few cents in front of it, or if I'm trading a futures market, a few ticks in front of it, because one of the modern, be polite here, problems with electronic trading is if you're trading on a platform that is a commission-free platform, which for the equities markets I do use, that company is probably using what is called pay for flow. In other words, they sell their order flow to a company like Citadel or Virtua, and then what happens is the algorithms that run those companies, they create liquidity for us, which makes it better for us. But at this moment in time, they take advantage of the retail orders, and they will front an order. Now, is my little teeny order causing the market to go down? No, it's not, right? Especially if you look at the 1 minute chart here, when we got to 137, it was about a million shares traded in that 1 million times. So, my little teeny order didn't matter. But the point being is that the algorithms will get filled first before the retail traders. And in this case, market went right to my target. And guess how many shares I got off, Thomas?
Zero?
Yeah, zero. All right. So from there, again, this is a penny stock. I talk about this as kind of a dog and fleas. But look, I talked about this in terms of a candle stock is that, this is the catalyst that I wanted to see this declassification, because what's going to happen next is, if that happens, then we're going to get some changes in some of the banking laws. And if that happens, then companies like Tilray, cannabis companies like that, are going to be able to legitimize their earnings, right? They're going to move away from cash purchases to be able to use credit cards. And which is really the biggest point is that they're going to be able to access capital. And that companies like Tilray are going to take advantage of that. And so this is not a story that is going away. I think it's just the pre-news has got the pop, as long as we get that declassification. So, if you're interested in the space, there's a lot of ETFs you can definitely look at, but we do have in the space, you can go in here and let's look under fundamentals here. And, I did this list, I don't think like 3 or 4 years ago. and there's a webinar you can watch that goes with it. Now, I sorted this by market cap. Now, the first 5 or 6 here, these are large cap companies that have exposure to the cannabis. Abbey is looking into medical. Altria, I think, they're probably planning to get into the cannabis. They still need that, that permission, let's say, from the federal government. But below there, these ones that are around 1 billion market cap, Cureleaf, Green Thumb, Tilray, Kronos, those are the ones. Some of them are more in the dispensary business. Some of them are more just green growers. What makes Tilray an interesting story is, here's their website, is that they are branding themselves as a wellness brand, and that they have a wide diversification of consumer products, not just flour and blunts and whatever you want to call them, but drinks and foods, and but also they're into this wellness space. I actually had these crackers. I tried them. These are hemp crackers. It has nothing to do with cannabis, like hippie cannabis, but they were really actually kind of delicious. And Tilray is a multinational company. It's in 3 continents and some in the 10 countries. So I think their ability to access capital will make them a very attractive company in terms of valuations. And what also could be valuations to somebody who is in this space, or somebody who is in a similar space like an Altria, who might say, hey, you know what? This company, which only costs $1 billion, is a good buy because we get exposure to this cannabis space that now is sort of been green-lighted by the federal government. So I'm not giving up on this one, but I'm not surprised that we had a little bit of a pullback after that initial pop.
All right, definitely one to track and keep updating as time goes by, John.
Yeah.
All right, well, that'll do it, guys, for today's show. As always, guys, if you liked it, leave a like, leave a comment, retweet. If you guys are watching on X, John and I greatly appreciate when you guys share the live show. John, we got a ton of questions. Are you ready for those?
Yeah, I do. I do want to talk about one question we had last week, Thomas, and the question was about UNG, which is the natural gas ETF. And the question is, why isn't UNG moving in respect to, let's say, natural gas, or is it a time to buy it? So one of the things that's happening in UNG right now is that anytime you're trading a futures, or a commodity ETF, they base it on the futures market. And so we just had the roll, which means that they were in the September contract, the futures contract, and now they've rolled into the November contract, a further contract. Again, November is in the winter months and is more reflective of what's going to happen in the winter. So the person who was asking is, why is UNG not moving, or that is why it's been depressed, is because it was still reflective of what's going on in the cash market or the current futures contracts. But now it has rolled into November. And so here, what we can see is this week, we got a little bit of pop in the UNG because now it's trading the November contract, which is a lot more expensive than the September contract. So that's just a little follow-up with a question somebody asked me about last week.
All right, John, we got another question sent to us ahead of time. And we looked at it, John, and we thought it was maybe a good teaching opportunity. And the question was about Tesla and the TTM squeeze, John. We have a tool on our website, TTM squeeze triggered, but it looks like Tesla didn't get that sort of surge in share price, and they just wanted to know, what was the reason for sort of, I guess you could say, the failed squeeze.
Well, we never know what the reason was, or all we can do is do risk management. So if you're interested in it, like Thomas says, it is one of our featured technical ideas. And if you go into templates, under bar chart templates, the first template is a TTM squeeze. So that's what I have up here. So how do you read this? Well, when you go into the red here, this is what is happening is the standard deviation Bollinger Bands, 2 standard deviations, and now they come inside a 1.5 ATR. And that's what's called the squeeze. And then when the Bollinger Bands break back outside of that, then the squeeze is on, or in other words, the firing. And so John Carter, who created this system, so when the green dot fires, that is telling you that momentum or volatility is coming back into this market. And then depending on which way price breaks out of the squeeze, you take a trade. Now he says that he'll take that trade, and then it usually lasts about 7 to 10 bars. So if we're looking at a daily, 7 to 10 trading days. So you can see that the histogram will reflect that volatility, but Tesla never really got that pop, right? Never really got that momentum to follow through. So Carter will say that he will wait for the histogram to fall below the previous peak high to get out of the trade. The way I use it, Thomas, is I will look at the candle that created the squeeze, which is this candle here, and I will use the low of that candle as a stop. In other words, if the market doesn't move instantly, then the squeeze is not going to work. And so, it flirted with it with yesterday, but today, definitely, boom, you would have been out of it. And it looks like tomorrow or Monday, then Carter would have been out of it. So this is just another trading tool that you can use. And in this case, why it didn't work, we don't know. Maybe they'll set it up and squeeze it again. But this is what is important from is when you use these type of systems, you need to have a plan. And that plan not only is where is the market going to take you, is why you took the trade, but where you're going to get, where you decide that you're wrong and that you got to get out. Okay.
So, John, and you're my witness for this, John. Last week before MOC, we were discussing the potential of talking about United Health, and John, I am on record, and you are my witness that I was seeing signs of perhaps exhaustion. It just seemed like there was so much bad news, and the sell-offs were getting less and less and less. And I thought, okay, maybe this is a time to buy it. And now I wish we would have done the segment, John, because UNH has exploded. Obviously, a lot of you guys already know Warren Buffett took a $1.6 billion position in United Health. John, I also saw a few other hedge funds, including Michael Burry, also took a position in United Health. These are some smart people, some loaded people, a lot of money to manage. So we got a question here, John, which is this person owns United Health.
Mm-hmm.
They sold a 310 strike covered call expiring in looks like November.
Yeah.
What do you think about that trade, John? Does it seem like a smart thing to do?
I mean, I don't have a problem with the 310 strike. I probably would have been looking at these two candles here. Now, these are twins, but I bet you if we went into this in a lower time frame, there probably would have been something that we could lean on. Again, this looks like more of a reaction to this candle here. So, that would be around the 324 level. But again, look at this large gap here. So, we did go from one band to the other band, and that usually is a sign that probably we're going to have some kind of a mean reversion again. But, who knows? I mean, the market is, when Buffett gets in the market, everybody wants to jump on the bandwagon. So I wouldn't be surprised if there's some follow through on this one. So, in hindsight here, I think once it gapped open higher here, I think even this level here, that strike might have been too close for me. But I certainly would have thought about looking at, doing a strike around this level, especially if it's a November one, because, right, that's a lot of time. Now, on the other side of the question here is that there's still a lot of uncertainty about what's going on in UNH, and that is there some kind of fraudulent billing practice that had happened, and that's what's with the DOJ. So that's a lot of uncertainty in the market, but certainly Warren Buffett thinks that it was worth the investment, and so a lot of other folks as well. So, maybe they know something that we don't know.
Yeah, one thing I've noticed, John, is when Warren Buffett positions get disclosed, either a new position or an increased position, there's a lot of euphoria day one, maybe day two, but then that euphoria fades. Just something I've noticed lately. The one that comes to mind, exactly, you just pulled it up, John, is Occidental Petroleum, right? That's the perfect example of what I'm talking about.
So this is where he was been buying in this range. And boy, it's not only below what I think his average cost is, but it really hasn't really done much since then either, too, right?
Exactly. All right, so we got a question on crypto, John. The question is, what will be the leader, Bitcoin, Ethereum, or some stable coin? Uh, Bitcoin. Bitcoin is
Yeah.
the undisputed leader of crypto. I think it will remain the leader for years to come. John, I've been in this space for a long time, and I've always heard, there's going to be, it's going to be dethroned. It's an antiquated coin. No, no. Bitcoin's the leader, and Bitcoin will stay the leader for years to come. I think something pretty monumental would have to happen for it not to be the leader of crypto.
Unless like one of these secondary altcoins, there's some kind of intrinsic value or some way of, a substitution, or maybe is adoption and, transaction speeds or whatever. I mean, these are things that you understand more than I do. But I tend to agree with you. It's going to be the leader until somebody can knock it off its pedestal, and that might take a lot of different things to happen, right?
Exactly. We got another question at United Health. Yeah, we just covered that. John, what tools would you use to evaluate individual stocks making all-time highs? So the question is, if you see a stock it's been on your radar and you're potentially interested in making a purchase, what tools do we have available that would help aid your decision-making process?
Well, I don't want to go on all the tools, but check out this webinar. It's kind of funny that you asked that question. This is one I did with Jim Van Meerten, who does our chart of the day, and it's about swing trading and catching momentum. And so when you go into this webinar, we talk exactly about that. Can you look at stocks that are making new all-time highs? Because old highs, you can't make new highs without taking out old highs. And there are some techniques that we can look. For instance, our trend seeker and looking at weighted average. So what we did was we went into, we're going to go into stocks, new recommendations. And here's our trend seeker. So today there was 52 stocks that made a new buy signal based on our trend seeker, which is a proprietary system. And then what we did was we went in here and used one of our custom views. In this case, it's cherry picking. And then what we looked at is weighted alpha. And so what we wanted to do is we want to look for those companies whose weighted alpha is greater than some benchmark. And the benchmark being the one that we looked at was the S&P, which was around 18, I think. So anything that was above 18 would be ones that we would look for. So any of these would be good candidates. But what other things could we look at that could help us? And that would be, is this potential stock making a number of new monthly highs? And if it's weighted alpha, where is it related to its 52-week weighted or return? And how far is it from its 52-week high? So again, those that are making new all-time highs will be very close to their 52-week high. But if their weighted alpha is less than, let's say, their return, let's say over 3 months or 6 months, then there's probably a lot more room for that stock to run. So it's a little bit more about market theory. It's about, is momentum showing up in the charts, and are we making new highs in this increasing weighted alpha? So watch the webinar. It makes a lot more sense than me trying to explain it in 30 seconds.
So we got a question from Steven, who says he sold the United Health 295, 280 put spread for 250 expiring next Friday. Mm-hmm. So obviously on that trade, you would want United Health to stay above 295, so you can collect that 250 and sail off into the sunset. Not a bad trade. My only concern, John, on that one is United Health is very prone to sort of bad news announcements right now, and all it takes is one bad negative headline, and it could be at where we saw it recently over the last few weeks. So that would be my only worry in selling a put spread.
Yeah, again, when we're trying to find levels that we want to take, again, looking at the mean reversion on this one is around 265. I would have been a lot more comfortable because, again, where couldn't price go? Where would I be wrong, right? So I would be more comfortable trying to do some kind of a put spread where the mean is involved in this case. But because it's a put spread, your risk is limited, and so I don't begrudge it. I think it's actually probably a decent trade because I think you will get a follow through. What was the expiration next week?
Next Friday, yeah.
Yeah, I think you should be all right on that one. Hopefully.
John, do you think Tilray will fill the recent two gaps that are lower than the current price?
I have to look at the chart here. I wouldn't be surprised if we came back to that breakout level. Is that where the gap was? Yeah. So again, that would probably be a good. I mean, I would like to see it hold this gap here, right there, that little teeny gap, and notice that little gap is above our 200-day moving average. So that one would give me encouragement if we held that and then rallied up. But I would not be surprised if we fell back to this breakout level, filled this gap, and then returned up. But again, if we believe in the story that this is going to be something that is going to be multi-months or multi-years based on a change in the fundamentals of the regulatory issues, I really kind of want to see this hold the 200-day moving average.
We got a follow-up question on nat gas, John. The question is, you've been bullish. You've said you were bullish on it before. Do you remain as bullish, or has your thesis changed at all?
No, I think in long term, again, my horizon here is 3 to 5 years, and then I'm going to trade around what the market is doing. Recently, yeah, again, there hasn't been a lot of weather in the market. There, here's the September. Let's go to the September contract. Prices have been coming down, and also recently, what's going on Friday between Putin and President Trump is if something comes out of that could be a negative story for energies. In other words, crude oil and natural gas. In other words, allowing the sanctions to be relieved. And then more Russian natural gas flows into Europe and less LNG flows out of the U.S. So all your LNG providers, for instance, like Cheniere, I think I'm going to guess, I haven't looked at the chart, but I'm going to guess it's probably been down. And that is because of this anticipation that something might happen. But again, if nothing happens or it's going to take a while with what's going on with, a peace settlement, then I wouldn't be surprised if natural gas popped. But we are getting closer to the end of the summer season, and now we're going to start focusing on where we are on inventories for the winter season. And so I think we're probably closer to the bottom than we are look for the market to start to bottom from here. So that's something I'd be watching for.
All right, last one for the day, guys. John, is Google your favorite Mag 7 stock?
Well, I have exposure through all my passive, accounts. Like, we talk about our 401ks. So, yeah, I think it is my favorite. Let me just look at the list and Meta just seems like it's just unstoppable, right now.
Yeah, the one concern with Meta is their expense. The fact that they've been spending a lot of money, John, on AI and CapEx, and they're paying out some ridiculous. I don't know if you follow this story. They're paying out some ridiculous salaries.
Yeah,
people who have AI experience. I think something like $100 million signing bonuses. I don't know if that's sustainable because I don't know how long it's going to take sort of AI to deliver upon the promises, right? Upon the hype that people believe. So that's the only thing but I like the company. I like the stock. That's the only thing that worries me.
If you're looking for value, one of the things I do look at is the percentage above the 200-day moving average. And I kind of feel that when you get above 20, 25, you've probably gotten too far. And you can see the three that are right there. Google is, in that kind of that neutral to maybe a little bit cautionary. So if you're looking for value, it looks like the value trade here is in terms of the 200-day moving average is Tesla.
That's your favorite stock, right, Joe?
No, that's not my favorite stock. All right, we're going to leave it at that. Stop it. All right, buddy. You still in Turkey, or are you traveling again?
I'm in Athens, Greece right now. Tomorrow we'll be heading out to Santorini, John. A little fun in the sun.
Nice, very well. Have a little ouzo and some olives, right?
We'll do.
All right, folks, thanks for joining us. I hope you guys got something out of today's session. If you're watching on one of the social media channels or YouTube, please give us a thumbs up, drop us comments, tell us what you like. Until next time, best of health, manage your risk, and the good of all trading.